Welcome to The Explainer. So today we're uncovering what the data suggests might just be the single biggest blind spot in the market right now. Look, while everyone is frantically chasing the next AI breakthrough, pouring capital into highly speculative tech, there's a massive financial powerhouse just kind of hiding in plain sight. We're talking about a highly defensive physical business model that has been completely ignored during this entire tech boom. Yeah, we're talking about Domino's Pizza, ticker symbol DPZ. So the question is this just some discarded relic of the pandemic delivery boom, or is it actually an incredibly lucrative AI-proof cash machine that's currently trading at a massive discount? Let's get into it. Okay, let's dive right into this. There is this massive psychological contrast in today's market. On one hand, you have the wild AI hype, right? Stocks rocketing to astronomical valuations based on, frankly, unproven future cash flows. It's pure fear of missing out. But then, you contrast that with the reality of Domino's Pizza. The stock has dropped roughly 30% over the last year, and it's down about 32% over the last 5 years. Now, for the retail investor who's staring at tech charts all day, this probably looks like a dying company. But as we're about to see through the actual hard financial data, this price drop has created what the source numbers indicate could be a phenomenal hidden gem for value investors.
I mean, if a stock is down 30%, you'd naturally assume the underlying business is shrinking, right? That makes sense. Yet the data shows the absolute textbook definition of steady, reliable revenue growth. What we're actually seeing here is completely uninterrupted consumer demand. Back in 2021, Domino's brought in $4.12 billion in revenue. And literally every single year since, despite inflation, despite rising interest rates, despite shifting consumer habits, that top-line revenue just keeps climbing. This proves a totally crucial point. This physical business has absolutely zero tech cycle dependency. None.
In fact, by 2025, Domino's projected revenue hits $4.94 billion. $4.94 billion. I really want to emphasize this figure because it firmly anchors the sheer scale and the resilience of their demand. They are adding almost $1 billion to their top line over this measured period. They aren't inventing new microchips, they are delivering hot food to hungry people. And as we'll see in a second, they're doing it with an increasingly lucrative operating model that flows straight to the bottom line.
Now, what's really interesting about this next point is that top-line growth is totally meaningless if costs just eat up all your profits, right? But here, gross margins are actually expanding from 38.7% in 2021 up to a really impressive 40.0% by 2025. And it gets even better. Operating margins are climbing from 17.62% all the way to 19.31%. Let that sink in for a minute. During a period of historic food and labor inflation, Domino's isn't just maintaining its profitability, they are actively expanding it.
Expanding profitability despite inflation perfectly illustrates the company's elite pricing power and operational efficiency. Look, when input costs go up, a weak company just absorbs the loss. But a strong company, a company like Domino's, they have the brand loyalty and the sheer scale to pass those costs on, while simultaneously streamlining their own operations. Basically, they are squeezing more profit out of every single pizza sold today than they were 4 years ago. It's absolutely crucial to understand that. So, they're making more money, and they're doing it way more efficiently. What exactly are they doing with all that cash? Well, welcome to the share buyback machine. In 2021, Domino's had 0.039 billion shares outstanding. By 2025, they've aggressively retired shares, bringing that number down to 0.034 billion. That is a 12.8% reduction in the total supply of stock. Honestly, think of it exactly like a pizza. If you take away an eighth of the slices, every remaining investor suddenly owns a much larger, way more valuable piece of the overall company. And you didn't have to spend an extra dime to get it.
So they've bought back nearly 13% of the company to reward investors. That's great. But what about the remaining cash flow? I mean, they generate a massive amount of cash, and it's not like they need to build billion-dollar data centers to keep their business running, right? So how else are they rewarding the shareholders who are willing to ignore all the AI noise?
The answer? A spectacular dividend growth engine. Domino's has literally doubled its dividend payout, growing it from $0.12 billion in 2021 to a projected $0.24 billion in 2025. And the math shows exactly why this is so safe. Even after doubling the payout, those dividends only consume 35.27% of their massive $0.67 billion in free cash flow. This means the dividend is incredibly secure, with plenty of room to just keep growing. The data suggests that with this undervalued stock, shareholders are literally getting paid a premium just to wait for the broader market to wake up. Okay, but what about the cash they do reinvest? Well, it generates elite returns.
Return on invested capital, or ROIC, is arguably one of the best metrics to judge a management team, and Domino's ROIC has surged from 14.8% to 18.6%. And get this, if you isolate just their high-margin franchise model in 2025, it generates a staggering 34.1% return. No way, right? But it's true, because Domino's operates primarily as a franchisor. They just collect royalties on sales without having to put the heavy capital to build the individual stores. It's an infinitely scalable, wildly high-return model.
Now, to be totally fair and balanced here, we do have to address the elephant in the room. The thing that always scares away novice investors: negative tangible book value. By definition, this happens when a company's total liabilities exceed its physical assets. Look, if you just glance at a stock screener, a negative book value looks like a massive red flag. But in the context of an asset-light franchise model, it's actually a hidden strength. They use it strategically to maximize cash flow efficiency. Let me show you exactly how this works.
And this next part brilliantly illustrates that strategy. While Domino's carries $5.05 billion in debt, which leaves them with a negative tangible book value of $4.07 billion, the cost to service that debt is highly manageable. The interest expense sits at just under 4% of their total revenue. Because they don't own the brick-and-mortar stores, they just don't need heavy physical assets sitting on the books. They borrow cheap capital, use it to buy back shares and pay dividends, and easily, I mean easily, cover the interest with their massive operating cash flow. It's not a weakness at all. Actually, scratch that. It's a deliberate, highly leveraged, brilliant financial structure.
Let's zoom out for a second to the macro view and draw a really stark comparison. On one hand, you have today's AI tech darlings, right? Trading at astronomical valuations, built on completely unproven future cash flows, and facing this constant, lingering risk of sudden obsolescence. On the other hand, you have Domino's Pizza, trading at a heavily discounted valuation, boasting a proven, essentially monopolistic digital delivery infrastructure, and just throwing off billions in highly predictable cash flow.
So the absolutely crucial point here is this: Domino's possesses the ultimate anti-AI defensive moat. While software companies face existential disruption risks every 6 months from the newest language models, Domino's operates with literally zero AI disruption risk. Why? Because it's a physical necessity. Look, you can write all the code in the world, you can build the smartest AI, but quite simply, software cannot eat. Human beings are always going to need affordable, consistently delivered food.
Okay, let's run through the final checklist here. We have a business where revenue is consistently up, operational margins are actively expanding, outstanding shares are down nearly 13%, and dividends have entirely doubled, all supported by a 34% return on capital in their franchise segment. Yet, somehow, the stock price has fallen 30%. When fundamentals go up and the price goes down, the source data points to one super logical conclusion for value investors. This highlights a massive opportunity for anyone willing to look past the current tech hype.
Which leaves us with this final thought-provoking question. In a market totally obsessed with the next digital revolution, is the ultimate defensive investment actually just a box of pizza? The data certainly makes a compelling case. Thanks for joining the Explainer today. 2. Video production and engagement metrics. Recommended video title: The AI Blind Spot, Why Domino's Pizza, DPZ, is the ultimate value stock right now. Video description: While the broader market chases unproven AI tech, Domino's Pizza is quietly generating massive cash flow, expanding its margins, and aggressively buying back shares. Discover the hard data behind why this AI-proof dividend machine might just be the biggest hidden gem for value investors today. Suggested timestamps: chapters 00, The AI Hype versus Domino's Hidden Growth; 345, The Share Buyback and Dividend Growth Engine; 710, Debt Structure and the Anti-AI Defensive Moat. Pinned comment question: What do you think is the better long-term hold right now? A high-flying AI tech stock or a reliable AI-proof cash machine like Domino's? Let us know your investment strategy down below.